Session 2 will talk about the new monetary policy era for emerging markets. The chair for Session 2 is Dr. Francisco G. Daquila Jr. Dr. Daquila is the Deputy Governor of the Monetary and Economic Sector of the Bangko Sentral ng Pilipinas. Deputy Governor, you have the virtual floor.
Thank you. Thank you, Jade. Good morning, good afternoon, good evening to everyone, as the case may be. Welcome to this second session of the 2021 BSP Reinventing the Bretton Woods Committee International Research Conference. We'd like to thank our esteemed guests, governors, and board members for being here with us today, and also thank everyone for joining us online via WebEx and Facebook. My name is Francisco Daquila of the Monetary and Economic Sector of the Bangko Sentral ng Pilipinas, and I will serve as chair of the session on new monetary policy era for emerging markets. Now, before we start our discussion, let me first provide the session mechanics for how we are going to conduct our session for today. We will have two parts. In the first part, we provide each of our panelists the floor for discussion of the session topic within the context of their country experience. And each will have 15 minutes to do their presentations. The second part will be an open forum for 24 minutes, where we will have an opportunity to ask questions for the four panelists, and we will also read questions from the audience. To our viewers, you may ask your questions by using the WebEx chat box. Staff will also be monitoring questions from the Facebook viewers. Now, to begin, the COVID-19 pandemic has forced governments to spend heavily to mitigate the adverse effects of the health crisis. As the extraordinary impact of the crisis calls for extraordinary measures, most central banks resorted to unconventional monetary policy measures to ensure price and financial stability. These were proven to be effective as they were able to restore market confidence and ensure the continued functioning of the financial system. Due to their effectiveness, some central banks are considering these unconventional policies to become part of their normal toolkit even after the pandemic. However, some argue that their effectiveness diminishes and have long-term side effects, including on central bank independence and credibility. In this session, we will be discussing the monetary policy challenges faced by emerging market central banks during the pandemic. We will hear from our panelists the lessons they have learned in conducting monetary policy during this period and their perspectives on UMPs and other extraordinary measures. They will also share with us their experiences as they embark on a new monetary policy era as a consequence of this pandemic. And we are very honored to have distinguished speakers from emerging market central banks in our session today. And let me start with our neighbor, Governor Peri Warjio of Bank Indonesia. Governor Warjio has been Bank Indonesia governor since 2018. Before that, he was deputy governor and assistant governor for monetary, macroprudential, and international policy. He also served as executive director in the International Monetary Fund. He has enjoyed a long and brilliant career at Bank Indonesia since 1984, with a focus on economic research and monetary policy, international issues, organizational transformation, and monetary policy strategy, central banking education and research, foreign exchange, and external debt management. We are also privileged to have with us Governor Boris Vuljivcic of the Croatian National Bank. He has been governor since 2012. He was previously deputy governor and before that, director of the research department. This year, he was awarded with the prestigious Lamfalussy Award for Lifetime Achievement in the field of finance. He holds a doctorate in economics from the University of Zagreb. Governor Vuljicic's fields of expertise are macro and monetary economics, international finance, and labor economics. It also gives me great pleasure to introduce board member Thomas Hollop of the Czech National Bank. Mr. Hollop became a member of the bank board in 2018. He joined the Czech National Bank as advisor to the deputy governor and the governor, and later became the executive director of the Monetary and Statistics Department and the executive director of the Monetary Department. He obtained a PhD in theoretical economics from Charles University, where he also lectures in monetary economics and international macroeconomics. He regularly publishes articles on inflation targeting, exchange rate issues, central bank independence and transparency, central bank finances, and price convergence in domestic and foreign economic journals. Last but definitely not the least, we are honored to have with us Governor Martin Galstian of the Central Bank of Armenia. Governor Galstian had numerous executive positions at the bank as directors of Research and Training Center in Dilijan, head of Statistics Department, and head of Reserves Management. He teaches numerous courses at the American University of Armenia, where he has been named as the first recipient of the Excellence in Teaching Award. Governor Galstian holds a postgraduate degree from the John F. Kennedy School of Government at Harvard University. So without further ado, let us start with our very interesting discussion. And let me call on Governor Perry first. Thank you. Governor Perry.
Thank you, my dear friend, the Governor Francisco. Indeed, it's a great pleasure for me to be here, and thanks for BSP and RBWC for inviting me to speak on this very prestigious international conference. Let me just share with you how experience in Bank Indonesia to cope with the COVID and under and post-pandemic COVID. Let me have my slide, please, to assist us in discussing and also conveying our message on how Bank Indonesia policy makes coping with the central bank under and post pandemic. Next slide, please. And if we look at the COVID and global COVID, what we learn from the COVID? Three things. First, global imbalances, which is unsynchronized global economic growth. The country in the advancing and vaccination providing stimulus now is already recovering. But with that also, some come with the exit policy that being planned for a number of countries, Fed and other countries. But with emerging market, coping with the recovery. The second aspect of the COVID is carrying effect. The impact of the COVID to corporate, to business, which is also giving risk to financial system stability, risk to corporate economic growth, risk to non-performing loan, financial stability, of course, uncertainty. The third aspect is digitalization, which is acceleration. And how the central bank need to cope with the three main challenges. In Indonesia, first, we respond with the central bank policy mix. We cannot only rely on the old framework. we have to apply the new framework of integrated policy framework, exchange rate stabilization, low interest rate, quantitative easing, also macroprudential policy accommodative. Second, for the scarring and financial stability, we cannot work alone. We have to work with the government, with the financial system stability and related agency. Independency under interdependency, the spirit of coordination with respective independency. How then monetary fiscal policy? How macroprudential policy with microprudential supervision? How to cope with digitalization? We have to digitalize our payment system with a clear vision for integrating economic and financial digital. Industry consolidation, how to cope with the fintech, e-commerce, and also big tech, but also innovation and pricing policy, including how we need to prepare central bank digital currency. Let me share with the three aspects of this in Indonesia. Next slide, please. I do not want to spend on the next slide. We already know. Delta variant global still surrounding us. Global economic imbalance is the upper table upright, where some countries, US and other countries recovering, but many emerging markets still coping with recovery. Global uncertainty because of Fed tapering and others, as well as increasing US Treasury yield. That we need to cope. Next slide. In Indonesia, we already implement what we call it central bank policy mix. Indeed, I already published central bank policy back in 2018 and 2019. With this, we implement this integrated policy framework since 2010. Actually, just complement with ITF with macroprudential policy. How we have to achieve price stability and supporting financial stability, not only from monetary policy, but macroprudential. And how we need to also frame our exchange rate stability. And how to implement this. This is the framework that we already implement 2010 and how we implement during the COVID, now and going to the future. Next slide, please. We are also need to know where we our economy respectively in the economic and business cycles. Very important, Deputy Governor. In Indonesia, our economic growth last year under recession. Now economic growth is still up and will be going up 3.5 to 4.3% this year, 4.6 to 5.4%. But we are still experiencing wide and large output gap negative. So our economic cycle is just moving up. With that, that's why inflation is very low. Even now, on the lower bound of our target, 3% plus minus 1. And next year, I think we also still with 3 plus minus 1. Current account deficit is very low. And with that, our financial stability, financial cycle is also just moving up. Our lending growth last year is negative. Now it's only 1.2%, and we forecast 4.4 to 6%. So the financial cycle, credit cycle is just moving up. When economic cycle is moving up, credit cycle is just moving up. We have to know where we are in the cycle to frame how monetary policy respond, how macroprudential policy respond. Next slide, please. This is how we do it. We have the challenge of exchange rate stability because of the Fed tapering, but we need to direct monetary policy and macroprudential policy for domestic purposes, supporting economic growth, supporting financial cycle moving up, credit growth. How we do that? We just let the adjustment for the Fed tapering impact global spillover on the exchange rate as well as government bond yield. Let those make the adjustment. So that's why our exchange rate is quite flexible, and also government bond yield is up and down, responding of the global interest rate differential in the term of government bond rather than the policy rate. For the policy rate, we continue adopting low interest rate, quantitative easing using unconventional monetary policy, but also relaxing our macroprudential policy to be continue accommodative this year as well as next year. This is we apply in Indonesia how central bank policy make integrated policy framework to cope with COVID now and going to the future. Next year, I think we will continue accommodative macroprudential policy. We continue exchange rate stabilization for global spillover. But of course, next year we have to adjust our liquidity before we tend to increase policy rate. This is we implement. Next slide, please. But of course, there are some challenge. We inject so much liquidity in the economy. 5.3% of GDP. We do the quantitative easing. Also, under the emergency law, the central bank also purchasing government bond from primary market. This is emergency, not in the normal condition, up to end of next year, end of 2022. We purchased a government bond from primary market last year for 173 IDR trillion. This year 139. This too is unconventional monetary policy. Injecting liquidity in the financial system, also participating government financing in under the emergency law. The problem is that still floating around in the financial system. We need to work together to ensure our liquidity injection going to the real sector, because of course this is the purpose. Next slide. That's why we need to coordinate with the government, with the financial system stability to push, of course, credit cycle moving up. We need to address both from the demand side, from the real sector, as well as the banking sector. That's why we are going sector by sector. Those sectors, they're actually moving up. Export sector, some of the manufacturing sector, we push them. We push them with fiscal incentive, with relaxation of macroprudential, as well as some relaxation on the microprudential, and also sector that also moving for domestic economic growth. But of course, not all of the sector can also moving forward. Vaccination rollout, we are also applying sector by sector, working with the government. The spirit of coordination still respective, independent becoming important. How to push the real sector, sector by sector, vaccination, giving some incentive from fiscal real sector to push macroprudential relaxation to the bank, as well as microprudential from financial system stability. This is the spirit of coordination for financial stability and bank financing to support the business. Next slide, please. Digitalization is becoming important. 2019, I launched what we call it Indonesian Blueprint of Payment System. Very ambitious, but very clear vision. We want to integrate our national economic and financial digital. We launched our blueprint, Bank Indonesia, Indonesian Payment System. Deputy Governor, we already launched QR Indonesian Standard 2019, the only standard in Indonesia, national standard. We are now already also experimenting, piloting with Thailand and Malaysia as a cross-border QR Indonesian standard. I also looking forward to work with the BSP to work QR Indonesian standard to be cross-border. We also integrated open API. I think the service of the big bank, digital banking, fintech, e-commerce, we just launched what we call it open API, standard national open API for payment-based system, SNAP on the upper. We also developing our retail payment Bank Indonesia fast payment, 24/7 real time. We are developing, hopefully end of the year will be launched for retail payment BI fast, 24/7 real time to serve the digitalization of national. We also consolidating our industry to be end-to-end process ecosystem from digital banking, fintech, and e-commerce, considering them providing some also incentive for consolidating building unicorn. Last slide, please. We are glad digitalization is already moving up in Indonesia very fast. This is the new era. Accelerated digital economic and finance. E-commerce this year growing by 48.4%, very fast. Digital banking growing by 30%, very fast, as well as electronic money using growing by 35.7%. So this is actually the new era of digital economy and finance, which is Bank Indonesia effort on digitalization of payment system. With that, three key messages. We cannot use only one policy. We have to adopt central bank policy mix, integrated policy framework. Second, we cannot work alone. We have to coordination with the government, with financial stability to ensure growth moving, credit is moving, respective of independence of the country. Third, we have to assert our digitalization in the economy, real, as well as digitalization payment system. This is the new central bank of Bank Indonesia under and post pandemic. Thank you, Deputy Governor. Glad that later on we can have Q&A. Thank you very much.
Thank you very much, Governor. And we look forward to cooperation with Bank Indonesia, especially in the field of digitalization. Thank you. So let me move to our next speaker, Governor Boris of the Croatian National Bank. Governor?
Thank you for inviting me to this interesting conference. Good to see many of you, at least in this digital format again. And let me try to say a few words about the topic or how the monetary policy has changed for the emerging markets during this pandemic crisis. I like to quote Mr. Lenin, who once said that there are decades when nothing happened and there are weeks when decades happen. And last year, it looked pretty much like that. Suddenly, out of flu with the ongoing crisis, emerging market central banks, which basically were not participating in the quantitative easing type of policies that were done by the major reserve currency central banks, decided to add APPs to their monetary policy toolkit. And my country was one of them. So if you would have asked me in February last year whether the Central Bank of Croatia would ever do the APPs, I would probably tell you no. But by March, I changed my mind. And of course, this is not something that you expect to happen. It's very difficult to forecast these kind of events, but they were interesting in a sense that they have created an environment in which we assessed that adding the unconventional monetary policy tools that were already used, as I said, by the reserve currency central banks could actually be effective in promoting our goals. It's not that I know that when we discussed about it last year, it's not that we have not seen it in a way. In former Yugoslavia, for example, central bank has been doing quite a lot of monetizing of the government debt, but in a very different circumstances. So some people had flashbacks and said, look, we already did it, but it was already in 80s. So this is like, for them, it sounded sometimes like going back to where they were. But of course, the environment was different, and the whole setup of monetary policy these days is different. When we did the APPs and other emerging market countries, if you look today, you can say that they pretty much had the same type of the effects in terms of being successful in stabilizing the financial shockwaves as they were in the advanced countries, or as the APPs that were done by the major central banks in the world. First and foremost, they stabilized the bond yields, bond prices in the government bond market, which was our intention when we embarked on the APPs, but they had a less effect on the equity prices. However, equity market, capital market is less developed in the emerging markets typically, so this is then of less importance. But why did we do that? Why did we add it as purchases to our monetary policy toolkit? The reason was simple. At the time of the highest uncertainty, end of March, beginning of April, you had two types of pressures. One was on the exchange rate, and we do have a policy of stable exchange rate, not fixed, but stable exchange rate against the euro. And on the other hand, simultaneously, there was a pressure in the government bond market because quite a lot of investors were asking for redemptions from the investment funds because of the high uncertainty. And as the investment funds were then offloading government bonds to pay out these redemptions, that created a strong and increasing pressure in the government bond market. So in a way, you were faced with the choice of having to stabilize the exchange rate market on one hand by interventions, foreign exchange interventions. On the other hand, trying to stabilize the government bond market with the creation of a domestic currency. So basically adding to the pressure that you see in the foreign exchange market. So this is a typical example of sometimes conflicting goals for the central bank, but there was a little choice then because government bond market liquidity dried up, and allowing for asset management funds to stop redemption was something that we did not want to accept because it carried all other financial stability risks. So when we decided to do it, we said immediately in the beginning, we communicated to the market that we're going to do it in the pre-arranged amount and for a limited period of time. So from the first purchases that we did until the end of the APP, there were 4 months only. So the whole program lasted only for 4 months, and it successfully stabilized the government bond market without jeopardizing the other goal of stabilizing the foreign exchange market. Now, what are the conditions, if you think, when you can do these kind of things efficiently, when you can run seemingly policies, monetary policies, which are conflicting? I would say one precondition is that you have institutional track record and credibility accumulated before. The other one is that the fundamentals in the economy are good, and they were certainly much better than they were during the great financial crisis 12 or 13 years before, which means that the structural conditions should be okay, fiscal policy should be okay, current account, foreign exchange reserves, buffers. If you have all that in place, it's much easier to embark on the unconventional monetary policy route, and it's more likely that you will have a success. And the third thing, which is also very important, is that the shock was not idiosyncratic. It was basically a worldwide shock where you can deploy asset price purchase policies in a very benign financial environment where the major world central banks are basically pushing the pedal to the metal and creating an environment in which the risks of a sudden stops or capital flow reversals are significantly diminished. And these were exactly the conditions where we did our APP. Again, from the start, we limited the amount of the APPs and the time when it's going to be done. It was clearly communicated to the markets. We did a lot within 4 months. We did 5.5 percentage points of GDP of purchase of the government bonds. I think we were among emerging market countries second only to Central Bank of Philippines, if I'm not wrong, which did a 6% of GDP at that time. And when we ended the program, we also clearly communicated how the exit will look like, that we will keep all the bonds that we accumulated to the maturity. And we are basically then off the market. Everybody knew that, and the markets have accepted that very well. Now, looking forward, I would say that these tools that we use, unconventional monetary policy tools in our monetary policy setting, were something that we do not intend, and we also communicate that to the markets in a normal environment, but they could be used again in the case of the exceptional circumstances like the ones that we did last year. So not something that becomes our regular part of the monetary policy tool, but yes, something that we, if necessary, can use, as we did successfully again, should the need arise. Hopefully it will not. Maybe another thing that is worth mentioning is that in our case, actually, the smoothness of the execution of this program was also helped by the fact that we had currency swap arrangement with the ECB, and within the currency swap arrangement, of course, your credibility in the foreign exchange market at the height of the crisis is increased, which makes it easier also to execute this APP part of your monetary policy program. And maybe I stop here and then wait for your questions later. Thank you.
Yeah, thank you, Governor. So we'll have an occasion to have further discussion of the role of asset purchases, which have proved to be very useful in this pandemic. Especially of interest would be what would be the most difficult challenges faced by Croatia in its implementation, and how you address this. And in your exit, what and to what extent you're coordinating with the fiscal authorities. But we'll go back to these issues, and for now I'll call on Board Member Thomas of the SEC National Bank.
To everyone, I hope you can hear me well. It's my great pleasure and honor that I was invited by the organizers to join this panel. So it's a real pleasure. Please, I will now start sharing my slides. So hopefully it will go well. So yeah, I will talk today about the coordinated easing efforts by different policy areas that has been instrumental from the swift recovery from the COVID shock, which is now ongoing. More or less, it is in place around the world at different speeds, but it doesn't concern just the advanced economies. It's also shared by the emerging market universe. At the same time, I think it's fair to admit that so far in many parts of the world, the post-COVID recovery has been more inflationary than originally expected. We all know that inflation is quite elevated in the United States, to a lesser extent in the Euro area or UK. We've also seen a spike in inflation in emerging markets. And here, if you look at the right-hand chart, it is apparent that emerging market Europe has been the leader in terms of the inflation spike. Of course, the average number is distorted by a few countries with quite high inflation rates. But even if you look at those European countries that are part of the EU, they typically have inflation rates between 3 and 5%, which is in most cases above the central bank inflation targets. Well, it has started to create some concerns or policy debates about the appropriate monetary policy response. Why can we face such a fast recovery? Of course, first of all, it's the very specific nature of the COVID crisis, in which the economic recession of 2020 was driven by government administrative measures to address the pandemic. And once those restrictive measures have been lifted, thanks to ongoing vaccination and immunization of the population, it was quite natural to see a bounce back in the economic activity. But at the same time, as economists, we know that the economic system is not a kind of physical machine that you turn off for a while, and then when you turn it on again, you expect it to be functioning exactly in the same way as before the lockdown. And I think most of us were afraid that the lockdowns and the temporary disruption to the economic activity might have very adverse consequences for the corporate balance sheet and subsequently lead to a kind of financial crisis that could repeat the bad experience we have gained some 10 or 15 years ago with the global financial and economic crisis. And that's why, with the benefit of the lessons from the global financial crisis, what was different this time was a very heavy and implicitly coordinated stimulus coming from all the macroeconomic policy areas, so monetary policy, fiscal policy, as well as macroprudential easing in those countries that do have a developed macroprudential toolkit. Interestingly, though, the Czech Republic that I represent did not have to resort to unconventional monetary policy. It has been repeatedly said in this conference that this time unconventional monetary policies were not confined just to advanced market economies, the major central banks, but those policies have been deployed also by many emerging market central banks, but not the Czech National Bank this time. We did some modifications to our liquidity providing operations. In particular, we started to accept mortgage-backed securities as collateral in our refinancing operations with commercial banks. And we also extended or introduced a new facility for non-bank financial institutions to get liquidity from us in exchange for government bonds as collateral, which was a measure to address stress in the government bond market. So quite similar to the experience of Croatia described before me by Boris, but we didn't initiate any asset purchases or stuff like that. Actually, looking at our history from 2008 until now, unfortunately, the Czech economy in that period went through 3 economic recessions and through 3 periods of major monetary policy easing. The first one was the global financial crisis. The last one is the COVID shock. In between, we also had a milder recession associated with the euro area sovereign debt crisis and domestic fiscal consolidation. But interestingly, in those 3 periods, we were able to rely on conventional monetary policy easing in the first one and in the last one, the 2 deepest recession, while unconventional monetary policy in the form of an exchange rate commitment was needed only in the mildest recession associated with the domestic fiscal consolidation. And I think there are some differences that explain this experience. First of all, in the first and last recession, we had more conventional room to ease monetary policy. We also were able to see or benefit from monetary conditions being eased by a major depreciation of Czech National Bank. So in those two deep recessions, exchange rate works spontaneously as a macro policy stabilizer driven by the market, while in the middle recession, the milder one, we actually had to push the exchange rate to a weaker level with our policy as a kind of unconventional monetary policy tool to get sufficient monetary policy easing. And last, but I think most importantly, the fact that both after the global financial crisis and after the COVID shock, we had expansionary monetary policy alongside with expansionary monetary policy was the reason why we were able to avoid unconventional monetary policy. While in the second episode, there was a major and not well-timed, not counter-cyclical fiscal consolidation that has quite significantly weakened domestic demand at a point in time when external demand was also weak, and this really has caused deflationary pressures on Czech prices and within the context of our inflation targeting regime, we had to adopt unconventional monetary policy. As I've already said this time, we didn't use any unconventional monetary policy tools, but in general, of course, we've been affected by the swift response of the major central banks, including the ECB, which this time was much less hesitant to start massive asset purchases compared to the previous two macroeconomic recessions in Europe. And alongside with the major fiscal stimulus that have taken place, not just in the Czech Republic, but globally, I think this coordinated policy response has in fact helped the global economy to start recovering so quickly without major negative carryover effects on the stability of the financial sector, and also without any durable damaging impact on the corporate balance sheets. But of course, the time is coming for thinking about reducing the degree of monetary policy accommodation. You know that talk is already ongoing, both at the Fed and the ECB, about starting to taper the massive purchases of government securities. And this time so far, those debates have run in a relatively orderly manner compared to the taper tantrum of 2013. But I think it's still possible that once the major central banks start tightening their policies, there will be some outflow of money from emerging market universe, and it may start creating pressure on exchange rate depreciations of some of the currencies, or at least it may prevent some currencies from appreciating, because in the Czech Republic, we in the long run count on an appreciating trend of Czech koruna against euro, which is helping us normally to achieve low inflation rates even in a catching up economy. And if those pressures on weaker currencies combine with what we are already seeing, which is the global spike in industrial producer prices, a major spike in many commodities, not just energy, but also industrial metals and stuff like that, it may create pressures on inflation to increase further. And in the emerging market universe, we don't have the ECB's experience of long-term undershooting of our inflation targets and inflation expectations being anchored at too low levels. We typically start with inflation rates that was close to the inflation targets and inflation expectations being either at or above inflation target, which is the case also for the Czech Republic. And in this situation, central banks, I think it's time to start being concerned or at least careful in terms of our job, which is to anchor inflation expectations at levels that are consistent with achievement of our inflation targets in the medium term. So in the Czech Republic, we've already started to hike interest rates as one of the first countries in Europe, together with Hungary, and we expect to be continuing with this process for the rest of this year and most probably also during next year. It of course means that the fiscal and monetary policies that have been well aligned during the crisis fighting mode are now become a bit de-aligned again, because monetary policy for various reasons starts to get normalized ahead of fiscal policy. It doesn't face the same political economic constraints thanks to central bank independence, but also it's primarily the job of central banks to focus on controlling inflation and inflation expectations, while for the governments it's still natural to focus more on supporting the post-COVID recovery from the economic recession. But I think it's fine. The policies have distinct roles, and now we have really, in my opinion, moved from a crisis fighting synchronized mode of the policy areas to a more normal situation in which each policy has to primarily focus on its main mandate. So thank you very much once again for inviting me to this discussion.
Well, thank you, and thank you for that very informative presentation. Perhaps in the Q&A, you could touch more on what you think would be the relevant factors that central banks can consider in deciding between the choice of conventional as against having a mix of conventional and unconventional policies. Why you think an emerging market economy may want to go purely conventional? Second point is that you increased your policy rate at the time when GDP growth was, well, GDP was still in contraction. So how was there the market reaction to the policy hike, and how did you deal with it? And if you can share with us your experience in coordinating with the fiscal authorities on the alignment. We'll be very interested in that, because pretty soon we would also be considering normalizing the policy rate. So this is a very relevant question for emerging market central banks. So I turn to our next presenter, Governor Martin of the Central Bank of Armenia. Please, Governor.
Okay, thank you very much. I hope you can hear me well.
Yes.
First of all, yes, it's good to be with all of you, and thanks to Central Bank of Philippines and Marcus Allen Bretton Woods Committee for inviting me. It's an opportunity to see some friends, though online at this point. But let me share my presentation with you, and I hope you can see it as well. So before starting, I just want to mention that due to our policies done before the COVID crisis, we as Czech National Bank were able to kind of maneuver in a way that we didn't get into the area of unconventionality. So we reduced our policy rate and we did some other stuff, but it was very conventional to compared to the other stuff that was done by other colleagues in other central banks. My presentation will be mostly overlooking not only Armenia, but also the emerging markets in general, but also I'll stop on several points which are very much related to Armenian case in general. So first of all, let me start with telling this story, which is the public debt and the fiscal stimulus story. So countries entered the COVID period with much higher public debt, leading to more pressure for monetary policy action. So people were anticipating that the monetary policy will be more proactive because compared to the global financial crisis, as you can see on your left-hand side, the emerging markets had higher debt to GDP ratio, which was about 53%, that it grew much higher than afterwards. And on the right-hand side, you see the fiscal stimulus that was offered by countries and presented in the paper by my colleagues from the Central Bank of Armenia. So you can see that several of the countries which are emerging, they also made some stimulus on the fiscal side, which was around 2.5% of their GDP, and Armenia was not, was part of that group. Meanwhile, the leading countries in terms of being advanced and having much more space in terms of budget, but also having much more credible kind of markets and deeper markets, they were able to provide much more than that. On the next slide, you can see that in contrast to global financial crisis, emerging markets were able to ease monetary policy and get rid of this procyclicality trap, which we trapped in before this. And that, I think, was the hard work done by the central banks in gaining credibility throughout the years that were following the global financial crisis. As you can see on the left-hand side, there were many countries which lowered the interest rates during the COVID time. In our next slide, I would like to show you the story of CPI inflation. So the lower initial inflation and pre-crisis deflationary policies in certain countries were important determinants of crisis response. So here on the right-hand side, I would like to stop a bit more and tell you the story of Armenia and our monetary policy, which was done after the global financial crisis. So as you may see on the orange side, which is high inflation expectation, and this is our survey on inflation expectations. So for the years from 2011 to 2016, we were experiencing not high inflation, but our inflation expectations were extremely high. As you can see at the peak, they were around 70%. And after 2017, we deliberately decided, even after 2016, I would say, we deliberately decided to have disinflationary policies, somehow to make people believe in our efforts and then somehow to anchor the inflation expectations. And that's why I think that's one of the reasons that we succeed. And that was one of the reasons that we're able to stay conventional and to decrease the interest rates in the midst of pandemic. Currently, you see that our inflation expectations are rising and the uncertainty level is rising. And I would like to mention that at this stage, we are in the midst of increasing the rates, but I think we are somehow close to the end of the cycle. One thing that I would like also to mention is that compared to the other emerging markets, we start tightening much earlier. So it was done December 2020, compared to other friends and colleagues in the region who start doing it much later. We anticipated inflation which would come from supply side, but also there were secondary effects. Plus, we were thinking about inflation expectation part of the equation. So that's why we started earlier. And I think that helped us to gain even more credibility in the eyes of our fellow Armenians. And now we are communicating strongly that we are trying to come to the end and normalize somehow. So this is the slide which tells you about the monetary policy framework and the possibility of rate cuts during the pandemic. So while institutional factors, most notably higher central bank transparency, have enhanced the ability to conduct countercyclical monetary policy, you see that the countries which had inflation targeting framework, around 83% of them, they were able to cut the policy rate in the midst of crisis. And that's where we're kind of somehow cutting the trap line. Here you can see that most of our colleagues in the developing world on the emerging markets were using a lot of unconventional stuff, but also there were also possibilities for macroprudential policy. And we think, and at the central bank, we somehow estimated that smart macroprudential policies together with smart monetary policy would have given us more effect, and that's what we did basically. We moved to the lowering the buffer stuff. We also cut the rates. So I think that's dual approach helped us to weather the response and then to make it much more efficient that we could have even anticipated. And this is the slide that I think Boris talked about. We see Croatia right next to the Philippines, and we see that the asset like APP for the central bank in Croatia, it was around 5%, in Philippines even more. So people or the central banks basically were getting into asset purchase programs, even being not too close to the zero lower bound. So we see, for example, that Philippines still had room to cut the rates, but they also engaged themselves with the asset purchase programs. I think that could be one interesting point for our further discussion with the general audience. And here, in terms of giving us or Frato et al, they kind of summarize the stuff, the responses from the different central banks. And we see that what Boris was telling us about this tackling market dysfunctionalities and then kind of addressing the dysfunctionalities in different markets, that was 62% of the response that Frato and the colleagues got from the central banks. Now, probably one of the last slides. While unconventional monetary policy appeared to be more effective in emerging markets, the effectiveness varied across cases and types. So that's one of the things that we should be looking further down the road. So there were things that were kind of positive on these things. First of all, it was, if you look to the left bucket, you'll see that for the emerging markets, probably due to the surprise effect, but also to other stuff, you see that the trading days, and then you on the y-axis, you see the average daily change in 10-year government bonds. You see that after the asset purchasing programs, the decline of the interest rates or the steepening of the yield curve was around 20 basis points. Meanwhile, for the developed world, it was just 10. But there were also there's also a negative side of the story. So there were other factors such as central bank transparency, the non-residential investment share, or the monetary regime and the exchange rate regime, which did not seem to have an impact on all of this. So coming to my conclusions, that's what basically that is the case for Armenia, but I would like to share with you our thoughts on this. So we still think that good old credible monetary policy still matters, and that's the biggest part of the story. So the advice would be just to keep your house in order, and credible monetary and macro-prudential policies create space during a crisis. So if you want to get ready for the crisis, you should be behaving yourself properly and getting ready for that during the good times. So view the crisis as an opportunity to build up credibility. Crisis makes reputation. That was our case with 2014-2015 crisis. We were heavily criticized for having this inflationary policy. A lot of people on the right and left were criticizing us for having lower inflation than our target was, but we did it deliberately. We sustained our efforts, and now we see that during the crisis, people were thankful to what we did. because we were able to break the chain of kind of counter cyclicality, and we were counter cyclical, not pro cyclical. The effectiveness of unconventional monetary policy in emerging markets is not well established yet, so especially taking into account the underlying objectives and communication issues, I think this is an issue that still should be learned a bit more. And then the last but not least point is about clear communication, which is an absolute must and very critical for our effectiveness in all measures, because at one point in time, we realized that being transparent and communicating well makes so much good in terms of your reputation and your credibility that it's worth all the efforts that should be done. So that is all that I want to say at this point. I'll be happy to take any questions. Thank you.
Thank you for that, again, very interesting presentation. I'd like to cite especially this final slide that I think is very clear in terms of the conclusions that you draw. I think some discussion also, we could also discuss the differences in evidence that we get with respect to the effectiveness of unconventional monetary measures. Just on the slide 9, could you explain further why you think the central bank transparency in that slide does not seem to have an impact on the effectiveness of unconventional monetary policies? And again, in the past, if you could elaborate whether you've had experience also with UMPs and APPs, especially during the COVID-19 crisis. So, so thank you. It's a great panel. I've had some specific questions addressed for discussion, but I also can draw some general questions that I could pose to the group. Well, coming from the presentations, we've had the views where unconventional monetary policy in the form of asset purchase programs could be usefully deployed by emerging market economies in support of their macro financial stabilization objectives in the current crisis. And that, well, a question now comes into that emerges would be whether it's reasonable for central banks to consider UMP tools as part of the toolkit during normal times. And I'd also like to address that to Governor Perry in whether he wishes that to be part of the integrated policy framework. And to everyone, are there any improvements in institutional frameworks that you think would be important that should be in place before a central bank can consider undertaking a UMP? Especially so with respect to the possible impact on credibility. I note that it has taken a long time to develop a credibility, especially with respect to the policy framework. So if there's a thought of introducing UMPs as a part of the regular framework, then how do you address that that issue? Whether there should be a corresponding changes in the institutional framework. So thank you. I'll stop there and invite any thoughts from the panel.
Thank you, Deputy Horacio. Can I start?
Yes, please do. If we could proceed in the order of presentation.
Okay, thank you, Jay. Okay, thank you. Indeed. The short answer is yes. Remember, for the central bank, there is a toolkit of interest rate policy.
Mm.
There is toolkit of liquidity. And of course, there is a toolkit of macroprudential policy. I think this is a toolkit that we deploy depending on the situation. During the normal time, when liquidity is just, normal, there is no need for the liquidity injection, then we can just rely on interest rate policy. So that's interest rate policy. But during, during the time where actually interest rate policy transmission mechanism is not working, then actually there is a need for liquidity. Then we call it just can be a conventional liquidity management, monetary operation liquidity management, but of course, there also we can do unconventional liquidity management, unconventional monetary policy, just unconditional liquidity management when we inject larger liquidity because the normal liquidity injection is not right. 3 point, the third point, how we do it, how to do the liquidity injection. This is where country by country is difference. In Indonesia, we do not have asset quality in the market, in the financial market. So we cannot do liquidity injection through purchasing the quality asset from the corporate, from the banking and so on. So what we are doing, the asset purchases through the government bond. This actually what we are doing. This is only in the situation of extraordinary condition, emergency condition. In the normal condition, we will come back with interest rate policy and normal liquidity management. I think that's the short answer to your three questions, Deputy Governor. Thank you.
Thank you, Governor. So if I can turn to Governor Boris.
Thank you. I think that this time around, it was, as I said, easier to add the unconventional monetary policy tools to the typical emerging market toolbox, because it was really a go with the flow kind of policy. But if you think of different setup in which you would have to swim against the tide, it would be much more difficult. Of course, as I said, this is not the case of idiosyncratic shocks. This was really a shock that hit the whole global economy in the same way, and the response of everyone was the same. So I would be much more skeptical about the ability of using this type of tools in a different situation when emerging market countries are faced with the idiosyncratic shocks. Then it's also a question why you deploying this type of the tools, whether it's because of the market dysfunctionality, as it was shown on the slide, what most of the central banks did, and it was really at the peak of the crisis where the markets were dysfunctional for a short period of time, and then you can do it for a short period of time, or it is because you are at the zero lower bound and you do it because of the inflation goal, which a number of central banks are saying that they are doing. Now, if it is because of the zero lower bound and inflation goal, then of course the question is, how much do we at the moment understand about what drives inflation? I think this is a key question for the central banks, and the one that is not well answered for the time being. If you look at the central bank forecasts for the last 15, 20 years, the largest errors of margins in the forecast were exactly on the inflation, which is the goal for the central banks. So this is something that we would really need to understand better. There's of course uncertainty at the moment about the inflation, how much of it is transitory, how much of it is to stay with us, and only time will tell. Also, I would say that if you do use unconventional monetary policy tools for a prolonged period of time, in order not to address the market dysfunctionality, but longer term inflation goal, let's say, or as it has been added now to the narrative of some central banks to control the financing conditions, then you have two types of the risks, not only the risk of the credibility of the independence of the central banks, because it's not only the governments that can get used to the long-term APPs, but also the markets. Markets get used to the APP if it's run for a long period of time, and then all these questions about how the market prices will react to the tapering emerge, and if that enters into the reaction function of the central banks, that we're talking about a different setup than the usual inflation goal monetary policy setup, and we should be very careful about that. Lastly, let me say that in our case, as a central bank country in Central East Europe, which does a lot of foreign exchange interventions in order to stabilize the exchange rate, we also do kind of asset price purchases. We buy foreign currency, and by buying the foreign currency to prevent the appreciation pressures, we create large structural liquidity surplus. So if you compare, for example, Croatian National Bank and the European Central Bank, and you compare our policies in terms of the structural liquidity surplus that we have been producing for the last 10 years, you'll see that it has been pretty much the same, except that we were not doing it through the APPs, buying the government bonds or other type of financial instruments, but actually by buying the foreign currency inflows. And for example, at the moment, the structural liquidity surplus in Croatia is 17% of the GDP, which is huge. So central banks in different setups can get to the same result or reach the same overall market conditions, at least when it comes to the bank liquidity, with very different, actually I would say not very different tools, but using the foreign exchange interventions, for example, as opposed to the APPs. I'll stop here.
Thank you. So I move to Board Member Thomas.
Thank you very much. In general, we at the Czech National Bank prefer to use the conventional monetary policy instrument, the interest rates in normal times, and to keep the framework for our monetary policy implementation very simple and easily understandable for the markets and the general public. So in our case, really, the unconventional monetary policy episode that I described in my presentation, it was really bounded in time. We started in November 2013, and we finished in early 2017 with a very clear-cut exit. We actually haven't intervened in the FX market since we exited from the exchange rate commitment, and with some time delay, we started to normalize monetary policy by hiking the policy interest rates, and this counter-cyclical monetary policy, it has actually paid off at the start of the COVID crisis, because we had 2 percentage points of conventional monetary policy space to be used. So we use it fully very quickly. And as I said, in combination with depreciated exchange rate driven by market forces, in combination with the macroprudential tools, which had also been tightened before the crisis and then eased suddenly when the crisis hit, and in combination with the fiscal policy, it was sufficient this time. Of course, I agree with the other speakers that for emerging market economies, unconventional monetary policy tools may be more frequently used to address market dysfunctioning rather than the zero lower bound issues, deflation risks, etc. This has been more the story of advanced market economies, while in emerging market economies, it's really the market disruptions, drying liquidity in the government bond markets, the large bid-ask spreads between government bonds in the government bond markets, etc. And here I would agree with Boris that programs to address those dysfunctions in the markets, they're likely to be shorter lived than the unconventional monetary policies addressing deflation risk and zero lower bound episodes. And this gives room for faster policy normalization subsequently in the emerging market world. And that's our phase now in the Czech Republic. We are once again moving back to positive interest rate territory. And we have also already started to bring back to normal the macroprudential toolbox by raising the countercyclical capital buffer. And we really take the current spike of inflation seriously. It was said in the first panel in the morning by Jakob Frankl that essentially it's our job as central bankers to make sure that the shock, which is originally temporary, doesn't spill into a longer lasting inflation episode. And I think to be able to do that, we need to be countercyclical in a symmetric manner. So it's good to ease if you have room to ease when things are getting bad, but then it's also good to normalize without too much hesitation when the economy starts get back to normal and there is an upside risk to inflation. Thank you.
Thank you. And Governor Martin.
Thank you very much. Let me do a couple of points here. So first of all, when I said transparency, I think it's not only about unconventional, but it's mostly about conventional. So transparency is just part of the framework that we have, and that's how we do it. So if you see your framework credible and you feel strong about it, then transparency is one of the basic tools that you need to have in your arsenal. Point number two, probably we need somehow to define what the unconventional and conventional is in terms of providing liquidity to the market. So from my perspective, when we're talking about functionality of the markets and providing liquidity to make them functional, that's part of the conventional story. The unconventional story comes when you are trying to influence somehow the term structure of interest rates or the yield curve. And then you are trying to dampen, for example, the long part of the yield curve. That's to me more unconventional. So Central Bank of Armenia provided tons of liquidity to the banking sector through our repo operations, which were at the record high level, but we see it very conventional because we did it according to our framework, we did it according to our toolkit, and so on and so forth. So we haven't tried to influence yield curve. That's why I think that the conventional part of the story is on our side. Regarding our own experience during the COVID, one of the important issues that we witnessed was because with everything else that you mentioned, we also experiencing a military conflict, a type of a war with our immediate neighbor, and that even made our job more difficult than for everybody else. So we were in the midst of pandemic plus in the midst of war for 44 days. And at that point, we saw that there is a pressure on our exchange rate, obviously. And what we did, we tried not to protect the level of the foreign exchange that we had before the war, but we started to communicate our kind of policies with the general public, and we let the exchange rate to depreciate by around 10% during 2 months. And that was also, and then what we were telling them, that was the story that it will come back with the economic factors being back. And when people are probably somewhere skeptical about us, but a lot of people believe to what we say, and they preserved their deposits in national currency. They didn't break the deposits. And then when the economic conditions were getting better and better and the exchange rates start appreciating, I think a lot of people gave us a credit, and now I think we were right in communicating and building up credibility during the crisis. Probably those are a couple of things that I want to mention. Thank you.
Thank you. Thank you very much. These are all very important issues, and there is a number of questions, but I'm also very aware of our time limit. So I think I'll just have one last question, and whoever wants to contribute, again in the order of our presentation, can do so. And this has to do with the exit strategy. For those of us that already started the exit, how did we handle the challenges? And for those that are still planning it, have we already made announcements to the market? During the pandemic, there was a great emphasis on coordination between the fiscal and monetary policies. So is there now also a coordination on the reverse side, that is the alignment of monetary policy with the fiscal policy? So I'll stop there, and if you could just have a quick run.
Thank you. Can I start?
Yes, Governor.
Yes. Yes, we are already planning. But it's not a good thing in the near term. First, our exit always be guided by our forecast of inflation and economic growth. Our inflation will continue to be low next year and will be start rising in 2023. And our economic growth output still negative, probably until 2023. So that's why, but we already exercising. So that's the first, the guidance. Second, about the sequencing and the timing. The timing we are planning starting next year, and the sequencing we starting with liquidity withdrawal first, bit by bit, slow by slow, and then at the end of next year we may thinking about policy rate, changing of the policy, depending our forecast of inflation and growth. That communication, we already talked to the market. We already talked the general principle, general framework, the timing, the sequencing. We need to talk to them so they do understand. They have to do understand. Of course, we will update, time by the time when there's new information is coming. I stop here, Deputy Governor. Thank you for the invitation. Thank you for the great conference.
Thank you, Governor. Governor Boris?
Thank you. I'll also be brief. So basically, as I mentioned, we already exited from the unconventional monetary policy in July. Beginning of July last year was our last intervention in the market. And we did communicate that in advance. We all communicated in the spring that our asset purchases will be short, that we will not repeat them, that we will exit by summer as we did. And we then said to the markets that we will also keep all bonds that we bought up to the maturity. So markets were well informed on the framework, on the timing of our intervention. And of course, that was also communicated with the Ministry of Finance from the end of March last year. And they also were on board with our decision on how to do it. So we are basically out of the unconventional monetary policy already, and the markets have taken that very well.
Thank you. Thank you. Board members, Thomas?
Thank them very much. As I have said, we've already started to exit from ultra low interest rates, and our forecasts have actually suggested that interest rate hikes could start around the middle of this year, already from late 2020. So it was well telegraphed to the market. Originally, the board was communicating that in light of the high COVID uncertainty, we would like to avoid a premature exit from low interest rates, and we would rather risk falling a little bit behind the curve on the inflation front. But once this has happened, it was quite obvious to the market that we need to start tightening in a rather fast manner. Actually, currently the market is pricing in more than our own forecast is suggesting. So it has been well taken by the financial market, this policy normalization process so far. It has been much less well taken by the Czech government. We are now in the middle of an election campaign ahead of general elections that are going to take place in 2 weeks. And according to the government's communication, they would prefer to have both low inflation and low nominal interest rates, which unfortunately we don't think it's possible in the current situation. So we stick to our remit, and we have started to normalize the policy to make sure that inflation expectations remain well anchored. And that's our job. We do it even at the cost of somewhat de-aligned policies currently with fiscal policy. But as I said, the crisis fighting mode is over, and we now need to focus on our primary objective. Thank you.
Thank you. And Governor Martin?
Not too many things to add to the discussion at this point because we were kind of conventional at our approach. But let me suggest one thing for the discussion, probably for our next conference. That would be the reaction of the emerging markets to what's going on with the US interest rates and the tapering as well. That would be an interesting topic to discuss.
Okay,
Thank you.
Thank you. Take note of that. So that brings this very interesting and fruitful discussion to an end. And in behalf of the Bangko Sentral ng Pilipinas, I'd like to express our sincerest gratitude to our distinguished speakers from emerging market central banks, Governor Periwarjo of Bank Indonesia, Governor Boris Bulicic of the Croatian National Bank, Board Member Thomas Hollop of the Czech National Bank, and Governor Martin Galstian of the Central Bank of Armenia. Apologies in advance if I mispronounced some of your names. Again, thank you so much for being with us today.
Thank you.
Thank you.
Thank you.
Thank you. Bye-bye.
Bye-bye.
Bye-bye. Thank you.
Well,
Bye-bye.